Hey guys, Nick Johnson. I'm here to talk about our Shell stock outlook. We work with a lot of Shell oil and gas professionals and executives, and for many of our clients, they're participating in the GESPP, the General Employee Stock Purchase Plan, the Shell Performance Share Plan, or have just accumulated Shell stock from other means. So I want to talk a little bit about that and talk about what our outlook is on Shell stock going forward and what you should be thinking about with your portfolio. The first most common thing that we see is that people that work at Shell have a disproportionate amount of their portfolio in Shell stock. And if we look at national averages, people that live in the South tend to have 14% more than the average in the nation in energy and utility stock. 14% more. Does that mean it's because people in the South have better risk return profiles having energy? No. Right? If you think about it, your base, your bonus, the performance shares, the GESPP, those are all tied to your company, in this case Shell, and frankly, you've got a lot of concentration risk through a lot of your income and net worth in the same company. But how's Shell doing? So if we look at Shell compared to some of the major oil and gas companies over the last 3 years, Exxon has had the best total return, up 120%. Shell has been doing phenomenal recently. Shell's up 97% or up 25% per year. Now this is all over a period of time where the S&P is up 10% or a cumulative 33% over the last 3 years. And when I show people this, or when they start looking at the recent performance of Shell, they start to think, wait, Shell's doing well, right? Energy's doing well. We haven't seen that for a while. Should I be holding energy longer? And if we think about a lot of what's going on in the world, most of these major oil and gas companies are driven by what is happening with oil prices. So if we're not thinking about the supply-demand dynamics of the oil markets, we can't really take into account what's going to be happening. And if we look at it from this perspective, we have to say, okay, what's happening with production? What's happening with consumption? On a production side, the U.S. companies are doing really well. Russia is producing less, and they're getting more challenged to produce and more challenged to ship since they invaded Ukraine. Like a whole mess, deglobalization going on there. So that's left the U.S. and OPEC to increase production. Overall, what we've seen is most of the increased production is coming from the U.S. Now, on the consumption side, what we're starting to see with the transition to green energy is the U.S. is not increasing the oil and gas that much. At the same time, we're not going down, right? We're still using as much oil and gas, we're just not going down. Most of the increase in consumption globally is from emerging markets. If we look at China, and we look at India, as they're growing middle class, as they're developing, they're using more fossil fuels, primarily oil here. And generally, as we're seeing these emerging markets grow and develop, our expectation would be there's going to be more demand, and as there's more demand, all else being equal, that starts to push the price up for oil and gas. So we do think if we look forward over the next 2, 3, 4 years, there's good reason for upward demand in the price of oil. When we look at Shell, one of the concerns, one of the things the new CEO has been talking a lot about is, man, Shell is not being priced fairly. The market isn't giving it a fair price compared to the U.S. oil and gas companies. And if we look at Exxon, it's got a market cap of $515 billion, or Chevron, it's got a market cap of $290. Shell's behind, and BP's behind at $225 and $102. And a big part of that comes down to the price to earning ratio. Are willing to pay more for every dollar's worth of earnings coming out of Chevron and Exxon. A big part of the reason that's generally believed for this is that Chevron and Exxon can focus on what they do well, being oil and gas companies. Shell and BP, being more Europe domiciled, have more pressure from investors, from governance, to be more green. And at the end of the day, the profits and the margins are coming from oil and gas right now. So overall, we've been seeing lower price to earning ratios, investors willing to pay less money for every expected dollar of growth for the European domiciled companies versus the US domiciled companies. And this has been a focus of Shell to say, hey, maybe we should change that. And if we look at some of the things that's been going on recently, Shell's been weakening its carbon emissions targets, right? They've been weakening their 2030 emissions cut. They've been saying, hey, the world needs more oil and gas, and they've been rotating a bit. They're still sticking with their, hey, we're going to be net zero by 2050 plan, but there's a bit of transition. Shell's also looking at other things to increase valuations. One of the things they've done recently for Shell retirees is they've moved the pensions from their balance sheet over to Prudential. Now, most people may not be aware of this, but generally in the investment industry, companies that don't have pensions tend to get higher multiples, higher valuations because there's less risk than companies that do have pensions. So by transferring pension assets and liabilities off Shell's balance sheet, that overall reduces risk for Shell and might help in increasing the valuations. There's also been talk whether they're serious or whether it's just to get some negotiating leverage in terms of what they're doing. Shell's been talking about, should we leave London and move over to the U.S. and be a U.S. domiciled company? Because then we're not going to get the same political pressure in moving away from the oil and gas industry where there's still a lot of demand. Now, all of these changes that have been made over the last year have contributed to really some phenomenal earnings numbers. Shell beat first quarter profit estimates and has been increasing their dividend and buybacks. This has really been helping out the value of the stock. So overall, when we look at Shell and we look at oil right now, I'm going to tell you we're kind of optimistic. We think energy could do well and could do better than the market. But the majority of our clients, especially if they're still working, you've got your base, you've got your bonus, you've maybe got performance shares, and if you're participating in the employee stock purchase plan, all tied to Shell stock. That's a lot. So for most people that are still working, we do think it actually makes sense to diversify, because if you've been getting grants, you've got 3 years of performance share grants that have not vested yet. Shell does well, those are going to do well. Shell does well, your bonus is going to do well. Generally, we believe that most of our clients should be diversifying away from Shell oil for this very reason. Now, if you're retired and when everything's paid out and you're looking at it and you've only got 5 or 6 or 8% allocated to Shell Energy, fine. It's not necessarily overly concentrated. You got to look at your individual circumstances, but that could be a different situation. But overall, right now, we're optimistic about the price of Shell oil. We think it could do well. And despite that, for most of our clients, we're still recommending diversifying. Make sure to subscribe to get more updates on what you should be thinking about your Shell stock and corporate benefits.